has been able to push back against regulatory changes coming from the nation's capital. Remember his verbal challenge to Ben Bernanke some time back. That's now changed overnight. The most immediate example of that is the Volcker Rule, which Dimon, of course, has criticized directly. 5 federal regulators in the process of finalizing that rule, banning proprietary trading. They're under intense pressure right now from the 2 lawmakers who turned that rule into law, Senator Carl Levin and Senator Jeff Merkley, to speed up implementation of the Volcker Rule, which is now set for 2 years, and to tighten its exemptions. Levin seizing on J.P. Morgan's news, saying in his statement overnight, the enormous loss J.P. Morgan announced today is just the latest evidence that what banks call hedges are often risky bets that so-called too-big-to-fail banks have no business making. Levin says the loss is a stark reminder of the need for regulators to adopt tough Volcker Rule language. Now, here's what Dimon said about that on the conference call last night.
This trading may not violate the Volcker Rule, but it violates the Dimon principle. It is very unfortunate. It plays right into all the hands of a bunch of pundits out there, but that's life. We'll have to deal with that.
Safe to say the industry's pushback against the Volcker Rule took a $2 billion hit overnight. Scarlett?
All right, thank you, Peter Koch. We're going to switch over to London now because these J.P. Morgan losses are coming out of that city, out of the bank's London office. Our Elliot Gotkin is standing by. And Elliot, the regulators have already started moving.
They have, Scarlett. We understand here at J.P. Morgan's headquarters, that pinkish building over my shoulders. They are in discussions with the Financial Services Authority, the regulator here, to find out exactly how London-based employees were involved in amassing these enormous positions and racking up that $2 billion trading loss. Now, we understand as well that the trader at the centre of this is one Bruno Ixtil, a Frenchman. He's been at J.P. Morgan since 2005, nicknamed in the markets as variously the London Whale because of the enormous positions that he amasses, and also as Voldemort, the chief villain in the Harry Potter series, because of the power he wielded over those credit derivatives markets. Now, there's no suggestion, of course, that he did anything wrong. There's nothing illegal about losing money. But, of course, just as regulators in the United States are cracking down on proprietary trading, even though J.P. Morgan describes this as a hedge, you can bet that regulators and indeed the government here are going to look very closely at this to see exactly if maybe the UK also needs some kind of rule against proprietary trading. And indeed, in the government, the Minister for Business, Vince Cable, routinely disparages investment banks as casino banks. So perhaps we'll get a cable rule, who knows, in this country, Scarlett.
Elliot, beyond the official reaction from regulators, what about the on-the-street reaction in London?
I'm sorry, I didn't quite hear that, Scarlett. Can you say that again?
The on-the-street reaction in London to all of this.
Clearly, we've got egg on the face of Jamie Dimon of J.P. Morgan. Obviously, its reputation is going to take a hit as a result of this. But as your previous guests have been saying, this is really just a drop in the ocean in terms of the amount of money that J.P. Morgan makes. But similarly, other banks here can perhaps take advantage of J.P. Morgan, exploit the position that it presumes that J.P. Morgan has taken to try to profit from itself. But at the same time, of course, I suppose others are aware that, you know what, just as J.P. Morgan got caught out taking these large positions, that they too could perhaps get caught out in this. And I doubt you're going to get very many rivals coming out to criticise J.P. Morgan, because they know that they themselves could one day soon be caught up in this kind of thing, Scarlett.
Yeah, you're certainly not hearing a lot of commentary from them at the moment on that. Thank you so much, Elliot Gotkin, joining us from London. Now, we have a lot more on this developing story. What does J.P. Morgan's $2 billion trading loss mean to the stock? And what about Mr. Dimon's reputation? We're going to answer those and more questions with a leading money manager. And with
Is this how you thought it would, this story would resolve itself after you wrote that initial piece?
I thought there'd be losses. I wasn't sure it'd be this big. Frankly, my reporting suggested that people within the group thought that worst-case scenario was $1 to $2 billion of losses, which is still significant. And frankly, J.P. Morgan underplayed when we first reported the story. But now we're saying, I reported late last night, it's $2.3 billion, and it could reach another billion on top of that, which is quite sizable and significant.
I wonder if you can share any more clarity about this hedge and whether or not you even call it a hedge in London, because obviously they can only tell us so much without exposing themselves to parties that don't have their best interests at heart.
Yeah, I mean, it speaks to the gray line between what's a hedge and what isn't a hedge. My understanding is they were betting on corporate credit. They were bullish on corporate credit. Historically, they've been a bearish group, the CIO group, and they became much more bullish, and that turned around and bit them and hurt them, and they tried to hedge that and adjust that, and it just didn't work.
Gregory, your latest story, which is on the blogs section of the Wall Street Journal online, it essentially indicates and points fingers to hedge funds that are actually making money off of JP Morgan's loss. Can you give us a little bit of detail on that, who these hedge funds are, what they have been doing, and whether or not this will continue as JP Morgan works to unwind these positions the rest of the year?
Yeah, that's exactly right. We reported in the last half hour that dozens of hedge funds and other trading firms have made money from this trade, taking the other side. And they've made not a remarkable amount of money, maybe $20, $30, $50 million each. Blue Crest is one hedge fund. Blue Mountain is another one. These are credit-focused hedge funds. In that world, the trade became very well known. People were buzzing about it, which is why we reported it about a month or so ago. And people stepped up and took the other side, thinking that JP Morgan either couldn't hold on to this position and would have to get out, or just that they created such an aberrance in the market that they would take advantage of it.
Greg, can I just double back on the work that you did on the initial story? What was the mood of the people that you spoke to? I mean, was there any sense in which they came to you, a feeling that perhaps communication within JP Morgan was broken, perhaps that these two very powerful people on both sides of the Atlantic, the whale and his boss here, were perhaps not feeding stuff back? I mean, what was the internal discussion like?
No, I would say they were very confident. They were almost dismissive of the original concerns and the original story. So I'm not sure. Now they're saying that there were issues of communication and risk management, but at the time they were very confident.
So and that goes for your sources as well, from whom you sourced the story?
Yeah, they said worst case scenario, the world comes to an end, we lose between $1 and $2 billion. And now they're trying to figure out what happened. I got to go. I'm about to take off a flight, guys.
All right, Greg, thanks so much for your time. Greg Zuckerman joining us from the Wall Street Journal. And again, we said earlier today.
Breaking news from Congressman Barney Frank, ranking member of the House Financial Services Committee. He is out slamming, what else? JP Morgan Chase. Barney Frank just putting out a statement moments ago. Basically, here's the gist of it. He says that JP Morgan Chase was complaining about the cost of regulation, perhaps under Dodd-Frank with the Volcker rule, et cetera, being $400 to $600 million a year. And Barney Frank saying, as only Barney Frank can, he finds it interesting that in one transaction, they have been able to lose about 5 times the amount that they complained about this costing them, i.e. regulation. So Barney Frank out slamming JP Morgan Chase, and as we suspected, saying this is exactly the reason why we need more financial regulation. Back to you.
Welcome back to In Business. Banks take risks, and sometimes they can lose huge sums of money. And it's up to the banks as well as their regulators to ensure that they survive their bad bets and remain healthy. JP Morgan's announcement that it lost $2 billion in a trading loss has intensified the debate about financial reform and supervision. So for more on all of this, we turn to Anat Admati. She's a professor of finance and economics at Stanford University.
Well, I think that fortress of his is hiding a whole bunch of things. If you actually reported it by the accounting standards of Europe, it would look like he's not as fortressy as he likes to say. But underneath that and off of that balance sheet, there is a lot going on there. And so even the $2 billion is not necessarily the end of the day, as you said. But, you know, what I found interesting is that JP Morgan lost, some stock price today, but the stock market went up. And I find that ironic because actually I do think that this, ironically, because it didn't happen sort of in a crisis, but it was a one-off kind of loss, is good news for us because it reminds people of the danger of these banks. Let me just, I quickly, when I was waiting here, looked at the quotes of JP Morgan and of Walmart. This is a comparison that Jamie Dimon made a year and a half ago in a New York Times interview. What he said was, we want to be like Walmart, efficient, big and all of that. I didn't realize at that time, and now I know. He's 10 times bigger than Walmart, right, and he has less in equity than Walmart, significantly. In other words, he has $2.1 trillion of debt. And now, of course, he has all kinds of hedges there, but we see how good they are.
Right, but Professor Admati, if the argument is that banks should hold more capital, banks like JP Morgan are plenty well capitalized. That doesn't seem to be the fix to the problem.
Well, you know, it would be a start. I think you talked about the Volcker Rule, and even this might not be under the Volcker Rule. So getting into their decisions and preventing all their losses from expected and unexpected scenarios is more difficult, but the capital that they have is actually low. I mean, his liabilities are all over the place, wholesale in other words. He doesn't need all of them to even grow. He should grow with equity even much more. These are, you know, risk-weighted assets, which he's going to optimize. There's all kinds of things going on there. And the balance sheets of Lehman Brothers also looked good with, you know, accounting tricks and other things. So I don't buy how Fortress and how, you know, good this, you know, entire capitalization thing.
Right, you basically don't trust the banking executives when they tell you how their financials are. Okay, so let's move forward here, Professor, and talk about how regulators should rework the existing Dodd-Frank and Volcker Rule as they try to finalize everything.
Well, my issue has been more on the capital requirements. And there, they have just totally violated the basic rule, which is when they have money, when they have earnings, why are they paying them out? So Jamie Dimon wants to paid last year $11 billion in payouts to equity, which just allows him not to shrink, but to grow with borrowing. And now he was approved to pay $15 billion more, which is more than 10% of his market value of equity today. He doesn't need to pay that out. He can build up his capital a lot more. So that's there. Dodd-Frank allows it, and the regulators just need to decide to go there, even above Basel III, which many of us have been saying is too weak. Volcker is very complicated to really parse what's legit and what's not legit. We've seen what a mess that is. There's been lobbying on different parts of it. It's become so complicated that some people have said it should be just, you know, we should scrap it, start all over again. So exactly how Volcker is going to work out is very hard to predict, and whether it's going to do the job.
And Professor Mahdi, it all comes back to these derivative trades, right? Warren Buffett has called derivatives weapons of mass destruction. Jamie Dimon himself didn't appear to have a very good handle on what exactly the bank's position was. How can regulators catch up in terms of understanding what's going on at any of these banks?
Well, that's exactly my point, is that it's very hard to be there in the moment and see how that all their trades that can change by the minute would work out. So the thing we want to do is make sure that when they miss or their counterparty is not there or something goes wrong, that they are not going to topple themselves in the system or just become distressed is enough. In other words, he can lose some and he can absorb some, but I don't want even him to get distressed or anybody worrying. The problem we have is that he can borrow at cheap rates, at subsidized rates, and by the time you can borrow cheaper than everybody else because you're too big to fail, the entire economy gets distorted.
Thank you for your perspective.
Thank you.
Professor Mahdi joining us from Stanford University, Professor of Finance and Economics there. Just ahead on In Business, we're going to have he covers the bank for Bloomberg News, and she's been on this breaking story from the very start. Dawn, here's the thing. When we look ahead, that $2 billion number that we keep repeating is not necessarily the final number, right? Because this trade will take a while to unwind.
No, and that's also after-tax losses. So before taxes, it's even bigger. And Jamie said yesterday that the loss will be could be another billion, maybe more than that. Could be less, but right now we know it's $2 billion. I don't think the bank would have disclosed this at this time. It's very early in the quarter if they didn't think there was a risk that the loss could grow much larger than $2 billion.
And by talking about it at this point and showing his hand, basically, Jamie Dimon makes the bank vulnerable to hedge funds taking up the other side as well.
Yeah, and that's what we're hearing is happening on the street, is hedge funds are taking the other side of this position and trying to squeeze the London whale into selling his position, into selling it at a loss. And so we spoke with analysts like Charles Peabody earlier today, and he had said that this is going to make it much more difficult for JP Morgan to unwind this loss. The market's going to get much more volatile. We're seeing it a little bit in some of the spreads, and that's going to make it cost a lot more money for the bank to get out.
We keep talking about Jamie Dimon. He's certainly the one taking the punches, but the person in the middle of the story is Ina Drew. She's a veteran. She has 30 years in the firm. How is she linked to all of this?
It's Ina, Drew, is the way she pronounces it, and she is basically the boss who oversees all of this. She is the chief investment officer for all of JP Morgan. So she oversees Europe, which is where the London traders are based, Asia, and the Americas. And under Ina is Achilles Macris, or Macris Achilles, and he reports up to Ina, and under him is the London whale, Voldemort. It's Bruno Ixil. Yeah. So she oversees. Yes, she runs all these guys. She's been their boss for a long time, and they report directly up to her. So the buck does stop with Ina.
All right, and ultimately, Jamie Dimon. Thank you so much, Don Kopecky, our Bloomberg News reporter who covers JP Morgan.
Thank you.